For the first time in 40 years, you now have the ability to deduct car loan interest off of your taxes. This is all in part to the passing of the One Big Beautiful Bill Act. There are some things you need to know, so let's take a look at those details together. It's the first time since 1986 interest paid on a personal auto loan is now deductible. And you don't have to itemize to get it. From 2025 through 2028, you can deduct up to $10,000 per year in interest paid on a qualifying car loan. This is an above-the-line deduction, meaning it doesn't require itemizing. You can stack it right on top of your standard deduction, the same way we talked about with Social Security, tips, and overtime. Now, to qualify, the vehicle has to be new, not used, and the final assembly has to have taken place in the United States. Now, it applies to cars, minivans, vans, SUVs, pickup trucks, and motorcycles. Personal use only, not business vehicles. Before you assume you qualify, there are a few details that matter. There's an income limit, so the deduction begins phasing out at $100,000 for single filers, $200,000 for married filing joint. You most likely will not receive a form from your lender showing how much interest you paid. Unlike a mortgage where you get a 1098 every January, you may need to track this yourself, either through your statements or directly with your lender. Now, the U.S. final assembly requirement is worth paying attention to. Not every vehicle qualifies, even ones from major brands. And if you're buying specifically with this deduction in mind, confirm where your vehicle is assembled before you sign. And if you've already purchased a qualifying vehicle in 2025, you may have some interest that's already deductible. It may be worth going back, pulling your statements. And here's where the rubber meets the road. No pun intended. How much car do you actually need to finance to get the full $10,000 deduction? Well, at today's average new car loan rate, around 7%, you'll need to be financing roughly $140,000 to $145,000 to generate $10,000 in interest in the first year. It's a pretty expensive vehicle. And most buyers are financing anywhere from $40,000 to $60,000, so the real deduction is probably closer to $2,500 to $4,000 a year. Still meaningful, but the $10,000 cap headline makes it sound bigger than it is for most people. Now, the deduction is highest in early years of the loan when more of your payment is going to interest instead of principal, and it decreases every year as you pay down your balance. The practical takeaway here is if you're buying a new vehicle with a payment plan between now and 2028, track your interest. If you're deciding between financing and paying cash, this deduction changes the math at least a little bit. This is not a reason to go buy a car if you don't need to. But if you're in the market, it could be a real benefit worth understanding and accounting for. If you need help understanding what the impact of a car purchase has on your finances, I'd be honored to give you clarity. Just hit the link below to schedule a call and get that process started. Next time, we're covering business deductions, bonus depreciation, Section 179, and TBI deduction. Big changes for business owners and self-employed folks. Looking forward to seeing you then.